Have the opportunity to speak to a distinguished audience like this one. First of all, I am not an academic. I will present something about the mining industry from the point of view of a company. And I have chosen this topic for my presentation. It means one of the challenges faced by the mining industry. There we have an icebreaker that's carrying nickel mined in northern Labrador to our refinery in Ontario, Canada. So it's one of the challenges of the mining industry is logistics. In Brazil, we face the challenge of moving about 300 million tons of iron ore from the Amazon, from the state of Minas Gerais, to our maritime terminals that are 800 to 900 kilometers away. This is a major challenge. And another challenge is geology. As you know, mineral resources are non-renewable, the reserves are finite, so you face the challenge of reduction of resource, not only in quantitative terms, but also in qualitative terms. You are getting lower grades, higher impurities, so costs decrease, and you have to develop new technologies to exploit them. And Professor Geman mentioned the news about the availability of mineral resource in the in Mongolia. Yes, there should be resource in this place, as there are indications that in Mars there is plenty of hematite, which is the best quality of iron ore. But up to now, the cost of exploiting these resources are too high, are non-economic. So we better innovate, generate technological innovations in the future in order to make feasible the exploitation of these resources. In this presentation, I'm focusing on two of the major challenges of the mining industry. First, price, and that was exploited by Professor Wengel, Professor Geman, about price volatility, the behavior of price. This is very important from the point of view of a mining company, given the structural characteristics of the mining industry. It's a very highly intensive capital activity. It's even higher in light of the rapid growth of emerging market economies, which are needing more metals for investing in housing, in infrastructure, in durable goods and proteins. So this is one of the challenges. And price volatility generates, of course, cash flow volatility. And how, in face of this, how to satisfy the kind of growth dilemma that mining companies face to financial growth initiatives, to satisfy the aspirations of our shareholders for cash in the short term, and also to keep a healthy balance sheet in order to minimize the cost of capital, which is a very important price, given that we need a lot of capital, billions of US dollars, to continue to invest, to maintain, and to expand our operations. The second is the risk posed by the interaction with the state, because the state is too powerful. It has the power of taxation and regulation to establish the rules of the game and to change them. The volatility of the rules of the game is very risky to companies, and in particular to mining companies, because we depend on license and so. We have to, with the exhaustion of natural resource, we have to go to more complex regions in the world where political and economic risks are even higher. First, I'll talk a little bit about Vale. Some of the audience is not familiar with our company. Vale was a company that was incorporated 70 years ago. This year we are celebrating the 70th anniversary. And it was a state-owned company. It remained as a state-owned company for 54 years. It was privatized in 1997. And these numbers speak for themselves. It's a very successful case of privatization. It's very important to show this in times when privatizations are being contested. There is, as I'm going to comment, there is an increasing trend towards more state intervention in the economy. So, by far, is a very interesting case. Vale, when it was privatized, is a typical Brazilian export-oriented company. We have only 4 ops outside Brazil, in the U.S., in Shanghai, in China, Japan, and Belgium. Vale was listed. Vale shares were listed only in Brazil. We have a small JV in California. And now Vale is a global company. We transformed a global company with presence in all continents. Our shares are traded globally in Brazil, in the New York Stock Exchange, in Paris, and Hong Kong. And I used to say that Vale is the most Asian company of the Latin American company, because more than 50% of our sales are destined to Asia, and we have a lot of offices and operations in the South Pacific. Our goal is to invest, and we have a large pipeline of projects to meet the long-term growth dynamics of emerging economies. We are investing in investment-based demand products for housing and infrastructure, such as iron ore, coal, and copper, and also consumption-based demands for durable goods and proteins, such as nickel and fertilizers. And our success, the success of Vale, was not due to chance or to cyclical factors. Here, there is the metals price index in real terms is supplied by IMF that shows cycles. We're just in an up cycle that started the early 21st century. But there are other cycles. We see more clearly, we see the long-term price for iron ore since 1900 that was built by the U.S. Geological Survey. In real terms, we can see very clear an upward trend since the end of the Second World War to the end of the 70s, then downward trend over 20 years, and now a new upward trend. So that's clear that the success of Vale, the sharp difference from the past performance is not only due to the cycle. There are other factors that explain it. I think that as an economist, I'm a strong believer in incentives. I think that people react to incentives. Right now, we have different incentives as a private sector company than in the past the state-owned company had. Our goal is to maximize profits, while in the past the goal was to maximize political power. Well, and how about metals price? According to several studies, I am summarizing one performed by the IMF. commodity price are influenced by macro factors, including base metals. Here's natural gas only for the U.S., but food, oil, natural gas, and base metals are influenced by macro factors. So business cycles are very important for the understanding of our price behavior and for the performance of our cash flow. This is the importance of a common factor is reflected in commodity price for movement. Price of different commodities with quite different market fundamentals tend to be correlated. And according to some studies, the price for movement became even higher among those commodities that are included in commodity price indices. Due to the investment in these indices, the price for movement tends to be more intensive among these commodities, such as copper, oil, soybeans, and others. And metals prices are associated with industrial production. The mining industry, we are basically suppliers of raw materials to the manufacturing industry. So metals prices are associated with the global industrial production. And the manufacturing industry is the most volatile component of GDP. Over the last 4 decades, 83% of the volatility of global GDP was associated to industrial production. So that imparts a volatile environment to base metal price. And one example is what happened after after the Great Recession of 2008-2009. There was a deep recession, very short one, or short duration one, and followed by a kind of a V-shaped recovery due to the reaction of emerging market economies in which the manufacturing industry is more important. So in this very fast recovery, one of the outcomes was the sharpest price increase in a recovery after recession. If you compare with at least with the last 5 global recessions, by far the recovery from the Great Recession of 2008 to 2009 was the one that shows the sharpest price increase in the recovery. And commodity prices tend to be negatively correlated to shocks to the US dollar. In simple correlations, that's a very high negative correlation between the shocks and metals price. And metals price are also associated to volatility in financial asset price. Here we have the correlation between the VIX, which is a very good gauge of financial asset price volatility, and metals price such as nickel, copper, and aluminum. Nickel and copper are highly volatile, as shown by Professor Wengel in his presentation. That's the daily returns in a more than 20-year period. And iron ore is, we don't have a long series because iron ore price for 40 years, they are set by bilateral negotiations with price fixed annually, and now we have more price volatility. For this short period of time from 2008 to 2012, there is volatility, but volatility is smaller than for metals price. And we identify price cycles for metals price. Using an algorithm called Ribose algorithm, identified price cycles for nickel and for copper. They are subject to cycles. And here is a summary of the cycles. For copper, in average, the duration is 35 months. For nickel, about 44 months. For nickel, the downswings tend to be equal in almost equal to upswings. In copper, the downswings are shorter than for nickel. The downswings are shorter than the upswings. And the behavior of metals price shows some similarity to stock price. They are almost unpredictable. They are subject to a kind of random walk. This is shown by the autocorrelation in returns. They have fat tails. You see the causes for nickel, for instance, between over the last 25 years, very high, and there is and they are subject to volatility clustering. You can see this by the significance in squared returns autocorrelation. This is an outcome of the process of price discovery. Metals price react to news, and when news are processed, the trading tends to increase, and as people tend to discover a new price. This can last for one day, for weeks or months, but this is a similarity with stock price as shown by the behavior of the S&P 500. There are some differences. For instance, the asymmetry during the cycles. Stock price tend to be more volatile in downswings and less volatile in upswings. This is very clearly shown by the behavior of the VIX. In the case of metals price, due to influence of inventories, volatility is higher in the upswing and down in the lower during the downswings, because the existence of inventories tend to accommodate downward price volatility. And last but not least, regarding the effects on inflation, Ishwar Prasad addressed the problem of how to deal with the effects of food price shocks. It's a challenge for monetary authorities, particularly in emerging market economies. Food price and oil price, they tend to cause shocks to inflation. It's not the case of metals price, as metals price are only a very small share of industrial goods. So the volatility in metals price has a non-significant effect on the inflation indices. They do not generate inflation shocks. In terms of cycles, metals price tend to be much more demand-driven, while in agricultural commodities, they are subject to shocks, supply shocks related to the weather. Even in the case of oil, although demand is very important, we can see sometimes supply shocks due to geopolitical factors. So in this sense, metals price are different from food, exhibit some different characteristics from food price and from energy price. Well, one of the byproducts of a financial crisis is a trend towards increasing state intervention in economic activity. And we see this very clearly after 2008 practically in all countries in the world. And this is very bad for the world economy, because state capitalism, or as Professor Gary Becker used to say, French capitalism, pardon me, our two French speakers have nothing against France, it's a wonderful country. But this is a system in which people get rich not because they are the most talented or they are hard workers. They get rich more because they have the right political connections. This generates a distrust in the system, distrust in the elites. It is not surprise that one of the byproducts of this crisis is the emergence of movements in the United States, such as the Occupy Wall Street on the left hand of the ideological spectrum, and the Tea Party on the right side of the ideological spectrum. They are quite different, but they have a common point. They do not believe in the system. They are challenging the system because they believe that the system is very unfair. In a country like France is the home of several very successful global companies. But systematically in opinion surveys, the French appear as one of the societies which do not believe in the system of free enterprise. And in this sense, China has a much stronger belief. China is a communist country. The society has a much stronger belief that the capitalist system is better for themselves. It's no surprise that Brazil has no political party that has as a goal to defend the free enterprise system. We find this in many countries, but Brazil, I would challenge any Brazilian to tell me this party is in favor, is a pro-market party. They are pro-business, which is quite different, but they are not pro-market. Well, in the mining industry, we are facing several challenges in this interaction with the state. Expropriation, we have seen this very recently in Argentina when the oil company was expropriated, and in other countries as well, in Africa, and a trend towards higher taxation. Last year there were 27 countries in the world, from Australia to South America, throughout Africa, with initiatives to increase taxes on mining. New regulatory frameworks giving a stronger say to the state in the decision-making process of mining companies, requirements for in-country processing in Asian countries, and barriers to foreign direct investment in several places in the world. So this is a continuation of this trend. Is populism, that means state capitalism, is one of the challenges faced by the industry. These challenges, these political challenges, have as the base, the basic arguments for that natural resource wealth is a gift from God. That in face of that, mining companies should be heavily taxed or even state-owned because it's a national wealth. It's not to be owned by the shareholders, one of particular company. There is the famous Dutch disease that was an expression labeled by the Economist a long time ago in 1997. It was about the discovery of oil reserves in the North Sea, related to the Dutch economy, and the argument goes that the discovery of new natural resource, price increase, led to exchange rate appreciation, and this to a factor reallocation, and by the end of the day to deindustrialization. The missing link in this argument is that, what's the impact on economic growth? And to prove that, one should prove that there is something special about manufacturing. and this is a proposition that's largely unproven. If you look at technological innovations, we have seen in many places that, we should move upward towards more value-added products. We should move into manufacturing because more value-added. Well, what the dynamics of technological innovation tells us? Well, we have seen at least over the last 20 years the most important technological innovations coming from the service sectors. There is the information technology revolution. It was not generated by General Motors or by a capital goods company. It was generated by the service industry. The case of Brazil, Brazil is now a powerhouse in the agricultural market, the global agricultural market. This was due to technological innovation in agriculture that was a result of serious research in this area. In the case of the United States, technological innovations in the extraction of gas, such as hydraulic fracturing, the so-called fracking, is going to reshape the manufacturing industry of the United States. If there is a trend towards reducing or even eliminating the dependence of the U.S. on imported oil, which will have important geopolitical implications. And this was not generated by manufacturing industry, but politicians, in particular in Brazil and other places, they see manufacturing industry as a fetish. The case of Brazil has seen recently the government reallocating resources towards the manufacturing industry, given special incentives, also tax incentives, sectoral benefits. And they forget to understand that in the manufacturing industry we have 13 million workers, but most of the Brazilians, 60 million workers, work in the service industry. So if they want to generate jobs, it's not the manufacturing industry the right place. And last, let's see an important sector of the manufacturing industry, auto industry. Cars remaining particularly the same over many years. The marginal improvements were due to the incorporation of information technology advancements that were generated in the service sector. And the natural resource cost, which was very well addressed by Thierry Verdier, I am not going to delve into the details in the theoretical aspects. He covered very well with a very good theoretical framework and literature. It's more extreme that natural resource countries, rich countries, are doomed to fail. I have seen this in practical examples in Brazil from authorities saying that we don't want to, you are a large commodity exporter. Well, it's just commodities. I'd like to see Brazilian companies to export manufactured goods, not commodities. Because natural resource rich countries, commodity exporters cannot be developed. But this is very out of sync with reality, as you know. And about the gift from God, people forget that to extract, to exploit mineral resource, you have to invest a lot. Over the last 5 years, only one company, only Vale, invested $5.7 billion in mineral exploration, in studies of feasibility, in adaptation of technology, technological innovations, creating innovation. So it's a lot of money, effort, physical capital, human capital allocated to produce a commodity. And very long horizon in the minerals are not uniform. For instance, I mentioned nickel. In Canada, we have sulfide nickel. In Brazil and Indonesia, we have different type. That's laterite, saprolite. In New Caledonia, we have laterite, limonite nickel. Each of these different types require different technologies for mining and for processing. To process this, to exploit this, it needs a lot of investment in physical capital, in human capital as well. And the mining industry as a whole invests every year billions of dollars just to take advantage of this gift from God. And natural resources have contributed to total factor productivity in Latin America, despite the restrictions. Today, at the opening of the conference, Dr. Sérgio Quintela, Vice President of Fundação Getúlio Vargas, mentioned the founding father of the Brazilian economist and the founding father of Fundação, that is Eugênio Goudin. And Eugênio Goudin have very hard debate against São Paulo industrialists. Unfortunately, he was defeated. The Economic Commission for Latin America imposed its ideas in Latin America. That's let's go for import substitution and tax the natural resource sector. But despite all these restrictions, Argentina is a champion because it's a champion of export tax and other on commodities and other distortions. There is a positive contribution according to the study prepared by the Graduate School of Economics professor Pedro Ferreira and others. Pedro is going to speak tomorrow at the lunch. There is a positive contribution of the natural resource sector to total factor productivity and ultimately to long-term economic growth. And here's just a summary. There are other countries that are rich and are natural resource intensive. Even the United States, if you see the history of California, you are going to realize how important were gold and oil discoveries in order to generate technological innovations for the building of infrastructure in the United States. And you see rich countries such as not only Norway, but Australia, Canada, and in Latin America, you see Chile. Once Chile started to adopt the right economic policies to have the good institutions, Chile has grown at a faster rate than not only than the global economy over the last 20 years, but it grown faster than the average of emerging market economies. So it's a fallacy. It's not necessary that a natural resource rich country is doomed to fail. It will depend on the several policies as it was very clearly shown by Professor Bernier. So, thank you for your attention. I have to take your questions.
First, you made a very interesting but subtle distinction between pro-business and pro-growth. Could you expand a little bit on what you mean by that distinction in the case of Brazil? And the second thing is, which is related, on the subject of what value Vale and other national resources firms are adding to the economy. You made a compelling case for Vale. So in that context, what are the policies, in addition to the tax issues, that specifically in the context of Vale and Brazil, you think really need to be remedied for natural resource extraction firms to continue contributing such value?
These are two interesting questions. First one, as a distinction pro-business and pro-market. Pro-business, it's our policy. First, pro-market. Pro-market is a policy of the prevailing of free enterprise capitalism. It's liberalization, deregulation, is let the market force to drive the economy. Pro-business is a capitalism that creates special incentives to special sectors, and it's equivalent to state capitalism, or again, as Professor Becker says, French capitalism, as when he compares state capitalism with free enterprise capitalism. And in Brazil, you have only not high taxation, but a very complex tax code that used to change frequently. The interpretation of the tax laws is subject to change. This is very costly, not only to natural resource companies, but across the board to companies as a whole. We see that large companies have to have an army of accountants, of lawyers. One of the most successful professions in Brazil is to be a tax lawyer, due to the complexities and the value invested and the value embedded in these tax disputes. And another point is bureaucracy. And all the indicators, the indices of doing business in Brazil shows that it's widespread. It's not a privilege of the mining industry. In our case, we face a very complex environmental protection regulation. In order to develop a project, one has to perform environmental impact study. Then you deliver to the regulator. The regulator has 24 months to analyze your study. And once they have a doubt about some point, they stop the clock and turn on the clock again only when they are satisfied with your response. By the end of this period, once you get the approval, you get the so-called preliminary license. The preliminary license just to say, well, that's okay. Now specify the measures you have promised to minimize the environmental damage. And then they have, once you present the application with the specification of the measures, they have up to 12 months to approve your application or not. Then you get the installation license. Theoretically, you are allowed to start the construction. But you have to get also an authorization for clearing the vegetation, because mineral deposits are not in the middle of the Fifth Avenue or in the middle of Vieira Soto. They are in the middle of remote regions where you have a lot of, sometimes the middle of the jungle. So you have to suppress, to clear the vegetation. And only once you get this authorization, you are free to develop your project. But once you are near to the conclusion, you have to apply for an operation license. And then it can take up to 6 months for you to get the operation license for finally start production. So these are restrictions to the mining company, but these are part of a general environment of high and complex taxation, and for the excess bureaucracy, the cost of doing business.
Summarize the estimated cost start to finish of getting a greenfield operation up and running, and with the technical problems and the regulatory costs.
Yes, investment costs for developing greenfield projects have increased substantially over the last few years. First, because of the inflation in equipment, engineering service, skilled labor for mining became more scarce. So in Australia, for instance, a truck driver makes about more than $120,000 per year. And if a Brazilian driver wants to migrate to Australia, is not allowed, even getting a visa from the Australian authorities, is not allowed to work in the mining industry because there are barriers posed by the union. But on top of that, you have, for many projects, you have to not only to invest the mine in a plant, you have to build a logistics infrastructure, or you have to extend the existing infrastructure. We are developing the largest iron ore project in the industry, in the history of the iron ore industry, that will bring an additional 90 million tons of production capacity. The investment cost for the mine and the plant is $8 billion. But the investment cost for the infrastructure, just to build some rail spurs and to duplicate the existing railroad, will cost us $11.5 billion. So more than the cost of putting in place a new mine. This is an example. And also, all these taxes and delays generated by the excess bureaucracy add to cost. By the end of the day, this will be translated into higher price for the long term, because in order to be incentivized to expand capacity, the mining industry needs higher price in order to justify the investment to their shareholders. They have to give the shareholders that they have to deliver value to their shareholders. They have to show that the expected rate of return is higher than the cost of capital after being adjusted for risk.
So there's a lot of talk of commodities as an asset class, and for example, exchange traded funds that hold physical quantities of commodities, and also some of them may be structured. How does that affect you as supplier, and the extent to which you also make use of derivatives forwards as a way of hedging your price?
We do not hedge against price volatility because we understand that because shareholders are in the mining business, it's because they like the business, they like price volatility. They want to be exposed to price volatility. And the financialization of metals price, I believe, is beneficial to the mining industry. First, because we have tested very intensively the effect of financial investors into price. We didn't find any significant influence of financial investors into price of commodities. I have seen some studies performed by IMF, by the Commodity Futures Trading Commission in the United States. They found also no evidence of that. But financial investors are very useful because they supply hedging service to buyers of our products. Otherwise, they will try to get the service for free for ourselves. This is the case for iron ore. Iron ore has a long history of annual fixed price that was dictated by the Japanese in the past. This old system lasted for 40 years, for 4 decades. And I saw that, for instance, between 2003 and 2007, when you followed this system, we left on the table more than $7 billion. Of course, we had the benefit of more cash flow stability. But what was a very expensive hedge to pay $7 billion that was transferred to buyers of our products. And since then, there is more flexibility, but the market, the iron ore market is transitioning towards a more liquid market, towards having more financial investors and being an exchange-traded commodity such as oil or copper and others.
In which state do you acquire a new mine when it is likely, like in oil we have proven, we have probable, and so on, the famous three Ps. So in the case of Vale, at which level do you decide to acquire a new mine, a new potential field, and in which of the three letters do you place yourself? That was my first
Well,
one.
we have, as I have seen the numbers showed, we have a very extensive global effort on mineral exploration. We have a lot of geologists. We also outsource mineral exploration to the junior mining companies. We share with them the benefits of the discovery. So our goal is not to buy mines from others. Our goal is to discover and generate our own products. And we have the largest reserves in the world of iron ore in Brazil. There's a huge potential for expansion. We have also the largest reserves of nickel in Canada, Brazil, Indonesia, New Caledonia. Copper, we have some reserves in Brazil. In coal, we have large reserves in Mozambique. That's very rich in coal. Mozambique could be the new Australia in terms of coal production, particularly metallurgical coal.
And my second question was, is it good news at this point to have sold your bauxite mine to Hydro in exchange for part of the equity in Hydro, a Norwegian company?
Well, we sold our aluminum assets to Hydro in exchange for cash, debt, and for a stake in Hydro. They are a best owner because they have the technology and they have access to low-cost electricity, and now they have world-class natural resources. While we had only the natural resource, and as we have shown, aluminum is a combination of natural resource with energy. But this is only a transitory position. We made an agreement with Hydro. There's a lock-up period of 2 years because we don't think that aluminum is a good business anymore. It's much more industrial business that has been dominated by the Chinese who have no discipline. They are expanding the supply without any constraints. And because they have subsidized energy, they have subsidized very cheap capital at their disposal. So we do not intend to compete with them in the industrial products. We compete with natural resources. They need natural resources and not industrial products. Well,
Explain a little bit more of the breakdown of the annual fixed contract negotiations in iron ore. Like I said earlier this morning, I'm not sure who brought it up, 70% of the trade in iron ore was from Vale, BHP, and Rio Tinto. And so nobody wanted to use the word cartel, but that one had the impression as an outsider looking at the industry that was producer-based pricing, you could call it. And
that's not true. That's not true.
so let me continue the caricature. And so on the other side, I wouldn't expect you to say it was true. We can't even say price when there's any attorneys in the room. But it was a highly concentrated industry in terms of the traded market. Now, on the demand side, I just the Japanese were the major players at that time, the Japanese and to some extent the Koreans?
Yes.
And so was the structure of the market changed as a result of the rising importance of the Chinese, and that sort of upset the dynamic or the relative importance of Japan? Would you accept that as a characterization if I left out the word cartel?
Well, as I had the privilege of being a long time ago a student of George Steele, the unregulated economist. He taught me that a collusion is a very difficult thing to reach because there are different interests involved. Collusion is very costly, and even if you want to form a cartel, BHP, Rio Tinto, and Vale have different interests. Even forgetting about the regulatory, the agencies around the world, about the European Commission, who is very tough on competition, there were no conditions to form such a cartel. On the other hand, we had on the other side of the table, initially the Japanese that were very powerful. In the past, the Japanese played the role of the Chinese. They were the capital-rich guys. They were hungry for raw materials. They bought stakes in several mining projects around the world. We still have several JVs with the Japanese, and they financed projects. Carajás, our very large mining site in the Amazon, was financed by the Japanese because Brazil declared default on the debt in the early 80s. The government of Brazil didn't Vale have any access to international financing, so were the Japanese that financed the project. And more recently, they were replaced by the Chinese. So China now is responsible for 60% of the global import of iron ore. They drive the markets, not ourselves. So if there is any market imperfection, there is a monopoly, not a monopoly or a oligopoly. So prices are determined freely by demand and supply, not by market power or so.
So why do the Chinese have a different view about the merits of flexibility in prices and the associated price risk than the Japanese and the Koreans were?
Well, because the Japanese, they got a free lunch for a long time. I was explaining to a colleague, if you let me use your car for free, and one day you tell me, well, Roberto, you have to use a taxi and you have to pay for the transportation service. I wouldn't like to do that. I would resist a lot. So, please keep lending me your car for free. It's very unfair to do it with me. This is the case for the Japanese and the Koreans. They want fixed price for 1 year. And the Chinese are the newcomers. The Chinese, the history of China tells us that China is divided between the Mandarins in the north, historically were in favor of state ownership or state intervention, the traders in the south. And we deal with traders. And they like price volatility. Well, thank you so much for your attention. It was a pleasure to talk to you, to exchange some ideas.
The framework is the same, about 45 minutes to 50 talk and then questions. So please,
First, thank you so much for inviting me to Rio. I come regularly to Rio, but I come to the competitive university in Booking. So finally they invite me to this side of the town. It's a great pleasure. Actually, what I wanted to do in this presentation, as opposed to present a paper, I thought I wanted to share some of the experiences that I have had in which I have connected the academic research on commodity prices and policy implications. And in fact, I have been very close to some of the developments on pre-sal in Brazil, and I want to start with some conversation about that, because it's very similar to the stories that Roberto Castelo Branco presented at lunch. First, I am from Venezuela, and if you know, the only thing that we produce in Venezuela is oil, no? Do we produce anything else? Do you know anything else about my country? Yeah, you know Chavez. So yeah, we have two products from my country: oil and really bad politicians. Yes, two natural resources. Yeah, we export the bad politicians. We tend to export that to Bolivia, Salvador, mostly Latin America, and then we export them and the influences to other places. But yes,
And Mrs. Roberto.
and Miss Universe, that is so inappropriate. I will never qualify my wife as a product. Is that okay? but it is true. Venezuela is the most successful country, Miss Universe and Miss World on there. According to my wife, that's also a natural resource. No. No. So truly, actually, I have all my life been embedded in oil, and what I want to do is to share a little bit of my experiences. A lot of what was talked today about the stabilization policies implied by commodity prices, how to estimate commodity prices, how to estimate contracts, how to write contracts, how to avoid expropriation, how to tax. These are issues that I've been working for 22 years. And I have had the privilege not only to work in the academic world, but actually to use part of that to policy implications. And what I want to do is to actually talk about that second part. As opposed to talk about the academic part, but how we do the estimation, I want to recognize some of the weaknesses we have on academia to understand the processes behind commodity prices and explain my experience of how that affected policy. Farah was here in Brazil when pre-sal was discovered. Pre-sal, if you don't know, is about 50 billion barrels of oil here just near